The curve is steepened 20 or 30 basis points, maybe less. And that really, it happened right after the debate, right after Biden's poor performance. The market started pricing in Trump, and everybody knows that the one Trump trade is the yield curve steepener, because Trump will exert a lot of influence on the Fed and influence them to bring Fed funds lower, the front end of the yield curve lower, and also he will spend and have tariffs, and that'll push the back end of the yield curve higher on inflation concerns. So everybody knows that the Trump trade is a steepener, and it's worked over the last couple of weeks. It really has a long way to go. I'm kind of doing the poor man's version of the steepener. I'm doing one leg of it. I'm just doing the front end of the curve.
I'd like to welcome back Jared Dillian to Wealthy On. Jared is an author, trader, a musician, entrepreneur, and educator. Jared, I trust you had a safe holiday weekend.
Yeah, it was good. Went out to the pool, went to the beach, stuff like that. Got a little sun, so it was healthy.
Excellent. Before we get going, I want to know how the newest book is doing. No Worries, How to Solve a Stress-Free Financial Life. I'm sure we can all learn a thing or two about having no financial worries.
Yeah, I would say, the book's been out about 6 months, and it sold pretty well for 6 months. And just in the last couple of weeks, it started to tail off a little bit. But it's done very well. It's done very well. I'm super happy with it. And the new book is actually coming out in October, which is Night Moves. It's a short story collection. So I'm super excited about that.
Is that your short stories?
Yeah.
Stuff that you've done?
Yeah.
Excellent. We look forward to that coming out, and we'll have to have you back, maybe even before that, to talk about the book and see how that one's going. So, Jared, I want to ask you, what's your overall take right now of the economy? I know that's a broad question, but I'm going to ask anyway.
Well, things are slowing down pretty significantly. I mean, so we got payrolls on Friday, which was kind of sandwiched between July 4th and the weekend, and a lot of people weren't around. It wasn't a terribly strong payroll report, and you really have to go back to the previous payroll report to get any strong data whatsoever. So it's really been a month of weak data. You saw Jay Powell speak and say that he's seeing disinflationary forces, and I have to agree with him, actually. He's a little bit optimistic. He thinks we're going to get 2% inflation next year or the year after. I kind of don't think that's going to happen, but nonetheless, inflation is coming down. If you look at the Trueflation numbers, they've been tracking below 2% for a while. So, I mean, the labor market is finally softening, which is something we've been looking for a long time. So I'm looking for lower yields in the future.
Powell's talking about labor markets. We did have that number, but it kind of, I know that a lot of people were on vacation, not looking at the market, but the market Friday had a pretty good day. NASDAQ and S&P hitting new highs, down not far behind it. What do you make of the market right now?
I can't make heads or tails of the stock market. It's really incredible. The NASDAQ is up 14 days in a row. It's like nothing matters, and I've been in this situation in my career a couple times before. One of them was in I want to say 2006, 2007. It was a similar environment, very low volatility. I mean, back then the VIX was actually below 10 and it got below 9 for a day. And the market was moving 20 basis points a day. Liquidity was abundant in the stock market. There was very little volatility. And that ended on February 27th, 2007. And that was the day that we walked in the morning and China had raised reserve requirements and the ABX was down 10 points and the market went down 3% in a day and the VIX went from 10 to 20. And that was really the starting gun for the financial crisis. So you're seeing, this, it's not to the scale of, 2018, where you had that kind of volatility suppression where people were piling into the short vol funds and stuff like that. But the similar things are happening now with covered call funds. There's a lot of vol selling, and if you suppress volatility, it tends to come back with a vengeance. And I think it's going to happen soon. So.
Yeah, you mentioned that in today's newsletter, the Daily Dirt Nap, how in 2007 it was, like you said, the VIX was low. As it is now, 12 is a pretty low VIX. You think it'd be around, a little bit higher than that, but in one day it just the bomb drops. Is it? You think that that's a possibility at this point?
I think something similar could happen. You typically don't. Volatility occurs in regimes. You have low vol regimes and you have high vol regimes, and the transition from a low vol regime to a high vol regime is usually pretty violent. So I have no idea what the catalyst is going to be. I don't know if it's going to be something around the election or something in the economic data, or who knows. But when it happens, we'll know when it happens for sure.
Do you remember what the catalyst was in 2007? I know reading your newsletter, you said it could be anything. It could be someone stubs their toe, and all of a sudden there's a huge sell off. And
Yeah, it was China raising reserve requirements, and the ABX were the two big catalysts. So, I mean, I remember it clearly. I was on the ETF desk, and I had just gotten into work at 7 o'clock, and at 7:30, some hedge fund out of London hit me on 400,000 EEM pre-market, and it was offered $4 below where I bought it when the market opened, and it kind of ruined my day. So,
I remember you saying it was probably the most money you've lost in a single day, and it was into the seven figures. So I get that. Toward the end of June, you were talking about a downturn in the market. I know that it dropped a little bit, that NASDAQ started to drop a little bit, but it seems to have picked up. And I know that this is a really, really strange market right now. Do you see it going higher from here?
I mean, for sure, it's possible. I look, like, I'm not. I'm bearish on stocks. Okay, but the way I'm expressing that, I'm expressing it in such a way that I'm not going to get burned if we squeeze even higher. So what I've been doing is I've been buying deep out of the money puts, long dated, like very long dated, 2026. Um, Stuff that is just incredibly cheap with a very low delta, right? So, if the market does rally another 5 or 10%, it's not going to affect me that much. And since, really what it's a bet on volatility, because if you're buying options in 2026, they're most affected by Vega, right? So you're looking at options with a buck 50 of Vega in the SPY, and if the VIX goes up 10 or 20 points, like, that's going to be a huge winner. So, yeah, that's like, I seem to, I used to kind of pride myself on the ability to time the market and, like, pick a top or pick a bottom. And I seem to have gotten worse at that over the years. So I just like to put on trades where I can just kind of hang out and, and just wait for the explosion to happen. So.
And you like volatility. What there are a lot of people like, oh, you know what? I can put my thumbs away for a little while and know that the market's just going to continue to creep up. But you like volatility. Why is that?
Well, I like volatility. Most people shouldn't. Volatility is the enemy for most people. Volatility is what makes people make stupid decisions, right? Like, really, if you think about it, the ideal asset class for a retail investor is a bank account with 8% interest, right? Like, it has a volatility of zero, it goes up 8% a year, it has a Sharpe ratio of infinity. Like, that's the ideal investment. If you're a trader, if you're somebody that thrives on market volatility, you want to see volatility because it really creates opportunities. But for 99% of people, like, volatility is the enemy.
Yeah, I haven't seen an 8% bank account since I think Ronald Reagan was in office.
1984, yeah.
it's been quite some time. So those were Reaganomics, but I guess those were the times when you'd have to balance your checkbook. You'd really have to look at the interest to find out how much money you were actually making. Now, Jerome Powell speaks this week. He's going to testify in front of the Senate, the Banking, Housing, and Urban Affairs Committee. What are you expecting from this testimony?
I think it's going to be pretty dovish. In Powell's latest comments, I mean, he basically referenced all the data that I referenced, like it's been coming in very soft. Um, I think it's possible you might actually get a concrete statement about a rate cut in September. I think that actually might happen. I think he could say that. I don't know what effect that's going to have on stocks because I haven't looked at the Fed funds probabilities in a while, but I think that's mostly priced in at this point. With twos at 4.6%, I think we're pricing in a rate cut in September. But yeah, I think it's possible that he could say that. And if the data continues to deteriorate, we could have a small rate cut cycle following the election. In 2025, you could see 100 to 150 basis points of rate cuts. I think that's possible as long as inflation behaves, which I think it will. So, and also it depends on who gets elected, and not to get too much into politics, but both candidates I think are considered to be inflationary, Trump especially. So that factors into it as well.
I was going to ask you about the election, not political wise, but in the market. There's a big difference between these candidates in what you're going to invest in, isn't there?
Oh, for sure. There is on every election. And it's kind of the same playbook. It's actually pretty boring. Like it's the same thing every time. Like, if it's a Republican, it's coal and energy and stuff like that. And if it's a Democrat, it's tech stocks. I mean, there's this playbook that seems to work all the time. Um, but there's the possibility, I mean, we don't have to get into Joe Biden's debate performance or anything like that, but look, there's potentially a lot of surprises. Like Joe Biden could not be the candidate, could be Kamala, could be somebody else, could be somebody who's competitive with Trump. So the idea that we're going to have the VIX at 12 all the way leading up until November seems kind of far fetched to me. So I think we're going to get some volatility.
Yeah, I love your sports analogies and you throwing out sports. I happen to remember Joaquin Andujar, and you did mention him in in a recent article. That Game 7 performance in the 1982 World Series was special, 7 innings as the Cardinals won the World Series. So that was a good one. But it looks like it's getting into the late innings for the Democrats right here, isn't it?
Yeah, I mean, they have a little over 30 days to figure it out. Biden has said he's not going anywhere. I mean, I don't know. I don't know how this is going to work out, but, you know.
What are you expecting? We do get CPI this week. We get, I think, Thursday, and PPI we get on Friday. If these numbers come in and continue to show slowing, and I know that rate cuts are baked into the numbers right now, but do you see a jump in the market if that happens?
Oh man, I hope not, but for sure, like I mean, for sure that's possible. I think the last headline CPI we got was 3.3%. So if it came in at 3.3 or 3.2 or 3.1, then yeah, for sure we'd get a jump in stocks. Um, I don't really have any particular insight into the data. Like I'm not a econometrician. I don't, I'm just a user of the data like everybody else. But yeah, and it seems to me like I also have exposure to the front end of the yield curve. I'm betting that front end rates are going to go lower. So, I think it is possible we could get a soft number in CPI. That seems more likely than not. So,
So talk to me about that yield curve. You have recently said that it had been inverted for quite a long time, but you're starting to see a trend in the other direction, which is where we want to be with that yield curve.
Yeah, it's happened in the last couple of weeks. The curve has steepened 20 or 30 basis points, maybe less. And that really it happened after right after the debate, right after Biden's poor performance. The market started pricing in Trump, and everybody knows that the one Trump trade is the yield curve steepener because Trump will exert a lot of influence on the Fed and influence them to bring Fed funds lower, the front end of the yield curve lower, and also he will spend and have tariffs, and that'll push the back end of the yield curve higher on inflation concerns. So everybody knows that the Trump trade is a steepener, and it's worked over the last couple of weeks. It really has a long way to go. I'm kind of doing the poor man's version of the steepener. I'm doing one leg of it. I'm just doing the front end of the curve. But this is a very popular and consensus trade on Wall Street. The curve has been inverted for almost 2 years, about 2 years
Right.
at this point. And a curve steepening trade in a rate cut cycle is one of the most easiest and profitable trades that you can put on. And people have been waiting for 2 years for this to work. And I think one of the reasons it hasn't worked is because it's so crowded. There are so many people in it. But if let's say we get a month from now and it looks like Biden is the candidate and it looks like a guaranteed win for Trump, you could see the curve steepen another 50 or 100 basis points. So
Explain to me how you would make money on that. You'd buy the longer term because or and dump some of the shorter term in order to make that money.
well, you would buy 2 year notes and you would sell 10 year notes duration weighted, right? So I don't know what it is in cash bonds. In futures, basically you'd be buying about 100 2 year note futures and selling 57 10 year note futures. It's actually 56.6. And you would do it in that ratio. And that's the way a lot of people are expressing it. So
And the bond market has been, according to some of your writing, has been about as wacky as the stock market has been. But that seems to be waning a little bit.
yeah, there's if you go back to 2023, the popular trade at the time was the higher for longer trade. And basically the thesis behind that was the economy was never going to slow down. We would always have inflationary pressures. There would always be pressure on interest rates to go higher. You had people talking about five and a half, six, 6.5 on tens. Nobody's really talking about that anymore. You had a big correction in rates towards the end of 2023, and yeah, I mean, I think the path for short term rates is lower. For I think long term rates is probably about unch. So
Rates directly affect housing, and housing has been about as wacky as everything with higher rates, but there's less inventory, there's higher prices, which is doesn't make any sense whatsoever. Can you make any sense of the housing market at all?
yeah, it actually makes sense to me. I mean, like this is one of the few things that have gotten right in the last year. So basically, we went through a period of about 10 years from 2010 to 2020 where we were chronically underbuilding homes. We were just not building enough to keep up with population growth, and that home construction picked up during the pandemic around 2021, and we've been building homes at a much faster pace since then. But it still hasn't been enough to keep up with population growth, and it won't be going forward. So if you think about this, 10 million people have crossed into the country illegally, right? And they're going to stay here, and they're going to get jobs, and they're going to rent apartments. And over the course of the next 20 or 30 years, they're going to have children. Their children are going to buy houses. Like we we cannot build houses fast enough to account for the increase in population. I mean, this played out exactly in Canada in the 2010s. They started this immigration policy. They were letting in legally 2% of the population each year. There wasn't enough building. House prices went parabolic. Like I actually think that home prices could go up significantly from here. Over on a 5 to 10 year basis. Not like this year, but over 5 to 10 years. I think it's possible for residential real estate to go up 50 to 100% from here. So, and it's really all about supply and demand. There was when interest rates first started to go up in 2021, 22. There were a lot of people who said, mortgage rates they went from 2.5 to 3 to 4 to 5. And people said, well, the housing market's going to crash because now, people can't afford these higher interest rates. Hasn't had any effect whatsoever. And I don't think it will have any effect. So, if you're long a house, if you're living in a house, I would hang on to it or buy more. So
What do you say to the younger generation that, like, I have kids that are going to want to buy a house someday, and I don't want to have to buy it for them. They're going to have a hard time affording this house because wages are not going to increase at the rate that home prices are increasing.
yeah, I mean it's a real problem, and I don't have a solution. I don't have an answer at all. The one thing I would say is if you're 27 years old and you're in a position to buy a house and it's going to be expensive, let's say you're looking at a $500,000 house and you have to come up with a $100,000 down payment, and you're looking at a monthly payment of 3,500 a month, and it's going to be a stretch. I would say make the stretch, buy the house. I don't think you'll regret it. And because 5 to 10 years from now, it could be prohibitively expensive, and you won't be able to access that at all.
Is it cheaper to build a house, Jared, than to buy an existing home?
So I just built a house, and I can tell you that it's not cheaper. Although I built kind of a fancy custom house, and the house I built ended up being about 600 a square foot, which was about $150 per square foot more expensive than the houses around here. Um, I mean, building is an option. The nice thing about building is that you get the house that you want, but 99% of home construction goes over budget, and you end up spending more. And it's also a huge amount of stress. So
So let's talk about some commodities. Oil. Right now, oil, obviously, that's one of the recession indicators, but oil right now seems to be in a good place. Um, how are we looking at energy prices?
Well, I was hoping you wouldn't ask that because I really don't have an opinion on oil at all right now. I mean, it's kind of settled into a range. Um, I think if it, so, just from a trading standpoint, if you're pricing in a Trump victory, I think energy stocks will go up. But long term, Trump is bearish for energy because there will be increased supply, there will be more drilling, and you'll see energy prices come down during his presidency. Um, if I think if Biden gets elected or any Democrat, then I think there's a decent likelihood that oil prices go higher. But that's really the extent of my analysis on this.
But right now,
Um,
oil is comfortable. You're happy with where the price is
yeah,
at this point.
yeah.
All right. What about gold? I know gold is something that you talk a little bit about. It's not something that you trade, but something that you hold on to long term. How how should somebody look at gold?
Well, gold has to be a part of everybody's portfolio. And I think the estimate now is that the average person has 1.5 or 2% of their portfolio in gold. And that's the average person, which means that about 10% of people have 10% gold, and 90% of people have 0% gold. You have to have some gold. Gold is the best volatility reduction tool that you can possibly have. When you add gold to any portfolio, it brings the volatility down because it is not correlated with other assets. And sometimes it is correlated, but those correlations aren't stable over time. So, gold is the best volatility reduction tool that you have. It could also go up a lot. the real trade on gold, and I did a Twitter thread on this a few months ago. But really, what it's about is I look at it as an option on debt monetization, right? So, as you know, the fiscal picture is terrible. We're basically in checkmate. Our interest payments are greater than our defense budget. It's all bad. Um, so, if there ever comes a time, let's say, for example, Kamala Harris gets elected and she has a Democratic majority in Congress. That's unlikely to happen, but let's say that it does. That 2 trillion deficit goes to 4 trillion. You're seeing huge amounts of pressure on the bond market with increased supply. Interest rates will go up, and they'll go up to the point where they start restricting economic activity. And somebody in the executive branch or at the Fed will say, "Hey, we have to act to keep interest rates low," and they'll cap the yield curve, which basically means it's like QE, but they're targeting yields. And that is really the end game for gold. That's where gold goes parabolic. So if you think there's a possibility that that's going to happen, that we're going to have just absolute runaway deficits, then gold is sort of the safety valve for that, and that's why you invest in it.
So you suggest physical gold or gold ETF, or what exactly should we be investing in?
It's always good to have a little bit of physical gold. You don't need a lot, 10, 20, 30 ounces, something like that. That's just kind of in case, it's just a good insurance policy to have. But the ETFs are really fine. I've traded the ETFs for years. I was on the ETF desk at Lehman when GLD was launched. I became an authorized participant for that ETF. And so I'm very familiar with the ETFs, GLD, IAU, stuff like that. And they're very liquid, and that's fine to put in a brokerage account. The only reason, if you're really, really paranoid and you think that there's any possibility that gold is going to be confiscated at some point, then you probably want to own physical gold instead of the ETFs. But I don't think that's going to happen anytime in the next, probably not in my lifetime. So I'm not too worried about it.
So authoritarian rule, it might not happen in our lifetime, which is a good thought, actually. But
Yeah.
let's talk about the debt a little bit. It just continues to grow, like you said. Servicing that debt is crazy. Spending isn't going to come down with either one of these presidents. And even if rates come down, they're not going to come down enough where it's going to matter. We're still servicing a ginormous amount of debt.
Yeah. It's we've done a pretty bad job at liability management in the Treasury. When interest rates were low, we had an opportunity to lock in interest rates. A lot of people talk about the 50 and 100-year bonds. And, there was when Mnuchin was Treasury Secretary, like he floated the idea and they walked it back. Basically, Wall Street said there's not enough demand for those maturities, and they ended up not issuing the 50 and hundreds. But even regardless of that, like if you had extended those maturities out to 10, 20, 30 years, and issued a lot more debt in the back end of the curve rather than the front end. But what we did was we ended up issuing most of it in bills and 2-year notes. And now we've had to roll that debt at progressively higher interest rates. And it was really a big mistake. I can't see, you can blame Yellen, you can blame Mnuchin or whoever was Treasury Secretary, but when 10-year notes were below 1% and you're not locking in those maturities out to 30 years, like that's just insanity. So,
how do we get this under control? Obviously, we have to spend less, and neither one of these presidents is going to do that. Is there a way to even get this under control, or is it just going to spiral and our kids are going to be paying for this and their kids are going to be paying for this for a long, long time?
well, you can get it under control. When people think about getting the debt under control, they think of it in terms of running a balanced budget. And with the math of the budget, it's almost impossible to run a balanced budget without just cutting almost all discretionary spending. So it's very hard to do, but thankfully you don't have to do that. This is the way it works. If you run a budget deficit that is smaller than your GDP growth, then you will outgrow the debt over time. So if we have GDP growth of 3% and we have a deficit of 2% of GDP, then that is a sustainable fiscal path, and we will outgrow that debt over time, especially if growth comes up, right? So but if we're running out of time to implement those changes, we really have to act now. And as you said, neither presidential candidate really has, or really anybody in government. It's funny, in the Trump Biden debate, there wasn't one single question about the deficit.
Right.
And I remember when I was a kid in like 1984, 1986, like you had the Reagan deficits, which were about 5 or 6% of GDP. They're smaller than they are today, and everybody was obsessively focused on the deficits. And you actually had political change. You had George H.W. Bush raise taxes, then you had Clinton raise taxes again. Then we balanced the budget in 2000.
Right.
I worked for the government during the Clinton years. And, Clinton was a Democrat, obviously, but he was not a big spender. And the message that we kept hearing from the top was that government agencies had to do more with less, right? We were getting fewer and fewer resources, and we had to, do our missions with fewer resources. And Clinton I mean, whatever you want to say about Clinton, like he was actually very good for the deficit. So yeah, we are not on a good path today.
Fiscal responsibility. Maybe we can ask AI how to take care of this. Are you bullish on AI and those type of stocks?
I'm actually sort of an AI bear. Um, it's the AI that we have today is pretty primitive. And I mean, everybody can see the potential, but the potential isn't going to be realized for 10 or 20 years from now. It really reminds me of the dot-com bubble. When I mean, it was almost an identical situation, except the difference was with the dot-com bubble, you had 2,000 dot-com stocks, and all of them went bankrupt except for four or five of them, like Facebook and Amazon and stuff like that. And then over the course of 10 or 20 years, the potential of the internet was realized. But I think AI is going to be similar. But the funny thing about AI is that it's the dot com bubble all rolled up into one stock, which is NVIDIA. It's one stock that is the dot com bubble. So I think if you had an ability to predict when that turn in sentiment in AI was going to happen, and you could predict when Nvidia would have a 30% correction, then I think you could actually do a pretty decent job of calling a top in the stock market. So
Yeah, you used to log on to the internet and listen to all those funky noises and whatnot. Now you're walking around with the internet in your hand, so it's a matter of AI getting to that point. I know we don't even realize we're walking around with some AI in our hand already, but it's I think you're right. I mean, that's 20 years ago. It's going to take a while for AI to really reach the scratch its potential, I think, before we get to that point.
yeah.
So, Jared, how do we protect ourselves? You think that there's a big volatility coming. You see signs back to 2007. How do we protect ourselves and our money at this point?
My experience is, I mean, look, like options are not for everybody. Options are for sophisticated investors. But if you have some facility with options, I can tell you that option prices are the cheapest they have been since 2019. Okay. They're the absolute. So if you think about this in terms of insurance, let's put it this way. Like everybody knows that homeowners insurance is really expensive right now, right? Well, if you go back about 7 years ago, homeowners insurance was actually pretty cheap. So if you, let's say 7 years ago, you had the ability to lock in your homeowners insurance at those rates, like you would absolutely do that. And you have the ability to do that today with options. Like and the funny thing is that people get insurance on their cars, they get insurance on their lives, they get insurance on their houses, but they don't have insurance on their portfolio, right? And oftentimes their portfolio is their biggest asset. And the cost of insuring a portfolio is the lowest it has been in 5 years. You absolutely have to take advantage of it.
So options, you talk to your financial advisor about options, or just go learn about it?
It's hard because I started my career in the options business. Like my first job on Wall Street was on the P Coast Options Exchange out in San Francisco. So I've been trading options for 25 years, and I have a lot of experience with this. It's like I said, if you don't have a facility with options, then there's a lot of ways to blow yourself up. You can get yourself in trouble. But if you know what you are doing, I would say yes, insure your portfolio.
All right, Jared, thanks so much. I know the newsletter is the Daily Dirt Nap, and where can we subscribe to that?
Yeah, just go to dailydirtnap.com. There's a subscribe button. Just hit the button. You send me an email, and if you mention the podcast, then I'll give you a discount.
And where can we find you on social media?
I'm on Twitter at Daily Dirt Nap, although I haven't been doing much on Twitter these days, but I'm still there. So,
And what's the name of your podcast, and where can we find it?
my podcast is called the Be Smart Podcast, and that's on iTunes and all the Spotify and all the podcasts, and it's a good podcast.
And when's the next? The last one's a few weeks ago. When's the next one coming out?
I don't know. We took a break of a couple of weeks. Maybe next week or the week after it'll come out. So
look for the Be Smart podcast. I know it's always a great listen. And Jared, thanks so much for joining us. I really appreciate it, as always.
Thank you very much.
That's a wrap on another discussion here on Wealthion. Thank you for joining us. If you need help being financially resilient, please head over to wealthion.com. Sign up for a free, no obligation portfolio review with one of our registered investment advisors. And remember to follow us on social media for the latest news and information to help you invest wisely. And if you could like and subscribe to the channel, we greatly appreciate it. Don't forget to hit the notification bell so you can find out when we post new videos to the channel. Thanks again for watching. Until next time, stay informed, be empowered, and may your investments flourish. And if you like this content, please watch this video next.